You open another investing app at 11:30 at night. You don't even remember installing this one. The notification said something about a stock that's about to triple. You've heard that before. You also heard it about the AI startup someone in your group chat swore was going to 10x. You heard it about the crypto coin your cousin pushed last summer. You heard it about the dropshipping mentor whose Lamborghini was actually rented. The pattern repeats. Every few months, something new appears on your phone, promising the shortcut you've been waiting for. You give it a try. You lose a little. Sometimes you win a little, get excited, then lose more. Your account has barely moved in 4 years. The thing is, you actually have the money to invest. You've had it the whole time. You earn enough. You save inconsistently, but you do save. You're not stupid. You read articles. You watch YouTube videos. You bookmark things you mean to come back to. But somewhere along the way, the entire definition of investing got hijacked. Investing started to feel like gambling with extra steps, like picking the right app, the right coin, the right sector, the right week to buy, like staying glued to charts, like having a take, the boring stuff, the stuff that quietly works, faded into the background while everything loud and fast and dramatic took up all the oxygen. And while you're doing that, while you're watching 3 streams about the next big thing, someone you went to high school with is becoming quietly wealthy. Not from anything exciting, not from a tip, not from getting in early on something, from buying the most boring possible assets automatically every single month for 15 years and never touching them. You'd never know it from how they live. They drive a Toyota that's older than yours. They live in a house smaller than yours. They wear the same 5 shirts on rotation, but their net worth crossed 7 figures last spring. And they didn't post about it. They didn't tell anyone. They just kept doing what they were already doing. That gap between you and them isn't intelligence. It isn't luck. It isn't connections. It's that they understood something almost nobody talks about, because nobody can sell it back to you. Real wealth is built almost exclusively through assets that are too boring to make headlines. Everything that's exciting, everything that promises speed, everything that rewards your attention is a trap that exists to extract money from people who haven't figured this out yet. Today, I'm going to walk you through 9 of those boring assets, the ones that quietly make ordinary people rich. None of them are secret. None of them require a special account, a connection, an inheritance, or a windfall. All of them have decades of data behind them, and almost none of them get talked about because there's no profit in talking about them. Quick disclaimer before we start. I am not a financial advisor. None of this is financial advice. This is education about asset categories, not a recommendation about what you specifically should do with your money. Your situation is yours. Use this as a map, not a prescription. Let's get into it. Number 1, total market index funds. Yes, this is the most boring possible answer, and that's exactly the point. A total market index fund, or an S&P 500 index fund, is a single basket that holds hundreds, sometimes thousands of U.S. companies in proportion to their size. When you buy one share, you own a tiny slice of every major American business. You don't pick winners. You don't predict trends. You don't try to beat anyone. You just own the whole thing and let the market do what the market has done for the last 100 years. The S&P 500 has produced an average annual return of roughly 10.3% since 1957, dividends reinvested according to long-running data from S&P Global. Over the last 100 years, the annualized return is around 10.4%. After inflation, the real return historically averages around 7%. Wall Street consensus heading into 2026 was clustered around 10 to 12% expected total return for the year. That's not a guarantee. There are years where the index drops 30%. There are years where it climbs 40%. But across long periods, the math is remarkably consistent. Money invested broadly in the U.S. market, left alone, multiplies. Let me show you what this looks like with concrete numbers. $500 a month invested in a low-cost S&P 500 index fund for 30 years, assuming an 8% average annual return after fees, grows to roughly $745,000. The total amount you actually contributed across those 30 years is $180,000. The other, $565,000, came from compound returns. The market did the work. You just kept showing up. $1,000 a month at the same rate over the same 30 years compounds to nearly $1.5 million. The contribution doubled. The end balance roughly doubled. Linear inputs, exponential outputs, but only if you let time stay on your side. The trap that pulls people away from index funds is the belief that they can do better. Sometimes they can. Most of the time they can't. SPIVA reports, which track active fund manager performance against indexes, consistently show that over 15 and 20-year periods, well over 80% of professional active fund managers fail to beat their benchmark index. After fees, these are people who do this full-time, with research teams, with information access most retail investors will never have. They lose to the boring index. The index doesn't try to beat anyone. It just owns everything and charges almost nothing. Modern total market index funds and S&P 500 index funds from major providers charge expense ratios as low as 0.03%. That means $3 a year for every $10,000 invested. Compared to actively managed funds charging 1% or more, those tiny fee differences compound into hundreds of thousands of dollars over decades. This is the foundation if you remember nothing else from this video. Remember that owning the broad market through a low-cost index fund and never selling it is the closest thing to a guaranteed wealth-building strategy that exists. Not financial advice, just observable history. Number 2, employer-matched retirement accounts. Specifically, the 401k and its cousins, the 403b for educators and nonprofit workers, the 457 for state and local government employees, and the thrift savings plan for federal employees. The reason these are quietly powerful isn't only that they're tax advantaged. It's that they often come with free money attached, and most Americans either leave that money on the table or don't even know it exists. 88% of 401k participants in plans that offer matching are eligible for employer matches. According to Fidelity, the most common formula is 50 cents on the dollar up to 6% of salary. Some employers match a full dollar for a dollar. Some go higher. If you earn $70,000 a year and your employer matches 50% up to 6%, that's a potential $2,100 a year in free contributions to your retirement every single year you participate. Vanguard's How America Saves report consistently finds that the average employee contribution rate hovers around 7.7%. Combined with employer matches, the average total savings rate sits around 14.2%. People earning the match aren't doing anything brilliant. They're just claiming what's already on the table. For 2026, the IRS raised the standard 401k contribution limit to $24,500. The catch-up contribution for workers age 50 and older is $8,000 on top of that. The super catch-up for workers age 60 through 63 remains at $11,250. New rule for 2026 worth knowing about. If you earn more than $150,000 in FICA wages with your employer the previous year, your catch-up contributions must be made as Roth, meaning after tax. Your plan administrator handles this. Just know it's a real change. Here's the boring math nobody talks about. Imagine someone earning $65,000 a year, contributing 6% to capture their full employer match of 3%. That's roughly $3,900 from the employee plus $1,950 from the employer, totaling $5,850 per year, flowing into the account. Invested in a low-cost target date fund or index fund inside the 401k at a conservative 7% return for 35 years, that account grows to approximately $870,000. Roughly a third of that came from the employer match alone. The match isn't a perk. It's part of compensation. Refusing the match is refusing free money. According to Bankrate research, about 1 in 5 401k eligible workers don't contribute enough to capture their full employer match. They're walking past free money every 2 weeks because the paperwork felt like too much hassle. Number 3, Roth IRAs. This is the account that quietly creates more tax-free wealth than any other tool available to ordinary Americans, and almost nobody under 35 takes full advantage of it. A Roth IRA is funded with after-tax money you've already paid taxes on. But every dollar of growth inside the account is yours to keep. After age 59 and a half, and after the account has been open for at least 5 years, You can withdraw both your contributions and all the gains completely tax-free. There is no other account type that produces decades of compounded gains and lets you walk away from them owing nothing. For 2026, the Roth IRA contribution limit is $7,500, with an additional $1,100 catch-up for those 50 and older. Income phase-out begins at $153,000 for single filers and $242,000 for married couples filing jointly. If you earn above those thresholds, look up the backdoor Roth IRA strategy. It's legal, it's been confirmed by the IRS, and it's how high earners still get money into Roth accounts. The math here is deceptive in the best possible way. Consider someone who contributes $7,500 a year for 30 years, starting at age 25, retiring at 55. At an average 8% return, the account grows to roughly $915,000. The total contributions over 30 years are $225,000. Almost $700,000 of that final balance is gain, and every single dollar of it can come out tax-free in retirement. Compare that to the same money in a regular taxable brokerage account, where every dividend and every capital gain triggers tax events. The difference between the Roth outcome and the taxable outcome over 30 years is often well over $100,000 in retained value. Not because you earned more, because the IRS doesn't get a slice. The trap that pulls people away from Roth IRAs is the belief that the money locked up until age 59 and a half is unavailable. This is partially wrong. Your direct contributions to a Roth IRA, not the gains, can be withdrawn at any time for any reason, without taxes or penalties. That makes the Roth a surprisingly flexible tool, even though the smart move is leaving it alone for decades. Number 4, health savings accounts. The HSA is the most underappreciated investing account in the entire U.S. tax code, and most people who have access to one are using it wrong. To qualify, you have to be enrolled in a high-deductible health plan. If you are, the HSA gives you something nothing else does. Triple tax advantage. Contributions are tax-deductible going in. Growth inside the account is tax-free. Withdrawals for qualified medical expenses are tax-free coming out. No other account in the U.S. tax code does all three. For 2026, the HSA contribution limit is $4,400 for self-only coverage and $8,750 for family coverage. There's an additional $1,000 catch-up for those 55 and older. Most people who open HSAs treat them like medical checking accounts. Money goes in, money comes out a few weeks later for a copay. That's not how the wealthy use them. The wealthy use them as stealth retirement accounts. Here's the trick. You can pay for medical expenses out of pocket today, save the receipts, and reimburse yourself from the HSA decades later completely tax-free. In the meantime, the money inside the HSA gets invested in index funds and grows. You're effectively creating a tax-free investment account with no time limit on when you can use the money for the medical expenses you've already paid for. After age 65, the HSA functions almost like a traditional IRA. You can withdraw money for any reason, paying ordinary income tax only if it's not for medical expenses. With medical expenses, it remains tax-free indefinitely. $4,400 a year contributed to an HSA, invested at 7% for 30 years, grows to approximately $416,000. Family contributions of $8,750 a year over the same period grow to roughly $825,000. The wealthy person and the middle-class person sitting at the same office have the exact same access to this account. One of them treats it as a critical wealth-building tool. The other treats it as a checking account. 20 years later, the gap between them is enormous, and almost none of it came from earning more. Number 5, I-bonds and Treasury securities. This is where the boring quietly outperforms everything dramatic. U.S. Treasury securities are loans you make to the federal government in exchange for a fixed interest rate. They are backed by the full taxing power of the United States, which makes them about as close to risk-free as financial assets get. Within this category, Series I savings bonds, often called I-bonds, are particularly interesting because they're designed to keep up with inflation. The Series I bond rate set by the Treasury for purchases from May 1st, 2026 through October 31st, 2026 is 4.26%. That includes a fixed rate of 0.9%, which is locked in for the 30-year life of the bond, plus a variable inflation component that resets every 6 months. The fixed rate of 0.9% is meaningful because it's a guaranteed real return above inflation for as long as you hold the bond. Most of the past 2 decades, the fixed rate was at or near zero. Right now, it's at a 15-year high. I-bonds have specific rules. You can only buy $10,000 of electronic I-bonds per person, per calendar year. You have to hold them for at least 12 months. If you cash them out before 5 years, you lose the last 3 months of interest. The interest is exempt from state and local taxes. Federal tax can be deferred until you cash them in, or potentially eliminated if used for qualified higher education expenses. Beyond I-bonds, regular Treasury bills currently yield around 3.75 to 4%. Depending on duration, 20-year Treasury notes yield close to 5%. These won't make you rich. They will protect a portion of your money against inflation while paying you interest that beats most savings accounts. The wealthy understand that the boring fixed income portion of a portfolio isn't trying to compete with stocks, it's trying to be the part you can rely on when stocks are doing whatever stocks do. According to Bankrate's 2026 Annual Emergency Savings Report, 59% of Americans can't cover a $1,000 emergency without going into debt. A small allocation of I-bonds and short-term treasuries solves that problem permanently while paying you interest at the same time. Not financial advice, just observable mechanics. Let me pause here for a moment, because something important is happening across these first 5 items. None of them require you to be smart. None of them require you to predict anything. They require you to participate in pre-built systems that already work. The S&P 500 doesn't need you to pick winners. The 401k match doesn't need you to time anything. The Roth IRA doesn't need you to do anything except keep contributing. The HSA doesn't need you to be a tax expert. Treasury securities don't need you to predict interest rates. Wealth building, when done right, is mostly about not getting in the way of mechanisms that already exist. The trap is believing that intelligence has to be involved. The truth is closer to the opposite. The more you try to outsmart the system, the worse you tend to do. Number 6, real estate, specifically modest owner-occupied real estate held for the long term. Notice the qualifiers. This is not house flipping. This is not vacation rentals. This is not the speculative stuff people post about online. This is buying a reasonable home you can afford, paying it down over 15 or 30 years, and letting equity quietly accumulate while you live there. The numbers tell a clear story. Median U.S. home prices have risen over 500% since the early 1980s, when many baby boomers were forming households. That's not annual return. That's total appreciation across 40 years. Annualized real estate appreciation in most U.S. markets runs somewhere between 3 and 5% per year, on average. But the leverage effect changes the math dramatically. If you put 20% down on a $400,000 home and the home appreciates 3% in a year, your investment of $80,000 gained $12,000 in equity. That's a 15% return on your invested capital, before counting principal paydown on the mortgage. The forced savings aspect of real estate is the part that quietly creates wealth. Every monthly mortgage payment includes principal that goes toward your equity. Over 15 or 30 years, those forced contributions add up to enormous numbers, even without any appreciation. The trap, and this is critical, is buying more house than you can afford. The Atlanta Fed's Housing Ownership Affordability Monitor shows that owning a median-priced home now consumes nearly 48% of the median household's income. That's almost half of every dollar earned going to housing alone. The traditional rule of thumb caps housing at 28 to 30% of gross income for a reason. Cross that line and the appreciation gets eaten by carrying costs. The house owns you instead of the other way around. Real estate becomes a wealth-building asset only when the house is appropriately sized for your income, when you stay long enough to absorb the transaction costs, when you actually pay it off, and when you don't keep ripping equity out for renovations and upgrades. The boring path here is buying modestly, staying for decades, and letting time turn the mortgage into an asset. Most of the people quietly building wealth through real estate are doing exactly that. They're not running spreadsheets on rental properties they bought with home equity loans. They live in the same modest house their friends keep nudging them to upgrade. Number 7. Index tracking dividend-focused funds. This is a specific subset of index investing that quietly produces some of the most reliable income streams available to ordinary investors. Dividend-focused funds hold collections of established profitable U.S. companies that have a long history of paying out a portion of their profits to shareholders every quarter. You buy the fund. The companies inside the fund pay dividends. Those dividends either get sent to you as cash or get reinvested automatically, buying more shares. The reinvestment part is where the boring magic happens. Each dividend reinvestment buys additional shares. Those additional shares produce their own dividends in the next quarter. Those new dividends buy even more shares. Over decades, the share count grows, the dividend payments grow, and the position quietly snowballs. According to research from S&P Dow Jones, dividends and dividend reinvestment have historically accounted for roughly 40% of the total return of the S&P 500 over the past century. Not the price appreciation, just the dividends compounding over time. A diversified dividend index fund typically yields somewhere between 2 and 4% annually in current income, while the underlying companies tend to grow their dividend payouts over time. The classic dividend aristocrat funds focus on companies that have raised their dividends every single year for at least 25 consecutive years. These tend to be deeply established companies with predictable cash flow, boring, reliable. The exact opposite of the high volatility growth stories that dominate the timeline. For someone in retirement or approaching retirement, dividend funds become particularly powerful because they generate income without forcing you to sell shares. You don't have to time withdrawals. You don't have to worry about selling at a market low. The dividends arrive whether the market is up or down because the underlying companies keep generating profits regardless of stock price fluctuations. The trap with dividend investing is chasing high yield. A fund yielding 8% often holds that yield because the underlying stocks have collapsed in price. Sustainable dividend funds yielding 2 to 4% from established companies tend to be the ones that actually compound. The flashy yields are usually warning signs in disguise. Number 8, rental real estate, but specifically the boring kind. There's an entire industry of online educators selling people on aggressive real estate strategies. Short-term rentals, BRRRR methods. Most of those strategies look great in a slideshow and end in disaster when something breaks. The boring version of rental real estate is what actually builds wealth, and it looks completely different from what social media shows you. The boring version is buying 1 or 2 single-family homes or small multifamily properties in stable working-class neighborhoods, putting 25% down, financing the rest with a fixed-rate mortgage, finding reliable long-term tenants, and holding the property for 15 to 30 years. The rent covers the mortgage, taxes, insurance, and a maintenance reserve. You don't expect the property to make you rich quickly. You expect 3 things to happen slowly. The tenant pays down your mortgage every month. The property appreciates modestly in line with inflation and local demand. The rent rises gradually over time, increasing your cash flow as the mortgage payment stays fixed. 20 years into this kind of ownership, the math gets quietly impressive. A property bought for $250,000 with $63,000 down at the start might be worth $450,000 20 years later, with the mortgage paid down to under $60,000 remaining. Equity has grown from $63,000 to nearly $400,000. The rent that was $1,500 at purchase is now $2,500 or more, with most of that flowing to you instead of a mortgage company. None of this required complicated financing, exotic strategies, or constant active management. It just required patience and the willingness to deal with the occasional broken water heater. The trap with rental real estate is leverage and overextension. People watch one tutorial and think they can buy 4 properties in 18 months. They overpay, they underestimate vacancy. They underestimate maintenance. They use variable rate financing or short-term loans that come due in unfavorable conditions. Then a recession hits, or a tenant stops paying, or a roof needs replacement, and the whole stack collapses. The boring rental investor owns 1 or 2 properties, has substantial cash reserves, and treats real estate the way it should be treated, as a multi-decade ownership commitment, not a get-rich-quick scheme. Number 9. Yourself, specifically your own earning capacity through skill development and credential acquisition. This is the asset nobody talks about as an asset, and it's often the highest return investment available to anyone under 50. Consider the math. If you spend $2,000 in 3 months of evenings earning a certification that increases your salary by $8,000 a year, your return on that investment in year 1 alone is 400%. The salary increase compounds. 2 years later, you're earning $16,000 more than you would have. 5 years later, with cumulative raises building on that higher base, the differential is well over $50,000. 10 years in, you might be looking at $150,000 in additional lifetime earnings from a $2,000 investment. No stock, no real estate deal, no business venture reliably produces that kind of return. Skill investments take different forms. A specific industry certification can dramatically change your earning potential in fields like IT, project management, finance, healthcare, or skilled trades. Negotiation skills produce immediate returns at every salary review. Communication and writing skills compound throughout a career. Sales skills convert directly into income in countless professions. Technical skills like data analysis, software development, or specialized software in your industry can pay back their cost within months. The trap here is what economists call the watered-down credential. Spending $40,000 on a graduate degree that doesn't measurably improve your earning capacity is not investing in yourself. It's consumption disguised as investment. The right credential, certification, or skill development is one where the income lift can be reasonably predicted, where the cost is recoverable within a few years, and where the demand for that skill is durable. The other version of investing in yourself is a side income skill. According to research published by Inc., 65% of self-made millionaires have at least 3 income streams. The barrier to developing additional income has never been lower than it is right now. Platforms exist for selling expertise, products, services, content, and skills. The infrastructure is built. The remaining work is the boring kind. Showing up consistently, building a real skill, charging fairly for it, and letting compound effects work over years. 5 extra hours a week of focused side income work, generating $1,000 a month, fully invested in a low-cost index fund at 8%, compounds to nearly $180,000 over 10 years. 20 years later, that same monthly contribution has grown to over $590,000. The 5 hours a week never feels life-changing in any individual week. The decade-long compound effect is. Now let me address the elephant in the room. Look at the 9 assets we just walked through. Index funds, 401ks, Roth IRAs, HSAs, Treasury securities, modest real estate, dividend funds, boring rental property, yourself. Notice what's not on this list: cryptocurrency, individual stocks based on tips, forex, day trading, options, NFTs, penny stocks, multi-level marketing schemes, dropshipping courses, forex signal services, real estate seminars, whatever the new app on your phone is promising tonight. The reason none of those things are on the list isn't that money has never been made in those categories. Money has been made in all of them. The reason they're not on the list is that the data across millions of participants over decades shows that the overwhelming majority of ordinary people who try those categories lose money. Studies of retail day traders consistently find that somewhere between 75 and 95% lose money over multi-year periods. Studies of crypto holders during the 2022 crash found that over half of investors who entered the market between 2015 and 2022 had unrealized losses. Studies of MLM participants find that the vast majority earn nothing or actually lose money after factoring in inventory and required purchases. The exciting categories sell stories of the few who won big. They quietly bury the millions who didn't. The boring categories don't need stories because the data already speaks. The S&P 500 has compounded at roughly 10% annually for decades. Roth IRAs have produced tax-free wealth for everyone who funded them consistently. HSAs have triple tax advantages by law. Treasury bonds are backed by the federal government. Real estate held for decades almost always appreciates. Dividend funds keep paying dividends. None of these need to convince you. The The math has already done the work for the people willing to be bored long enough to receive it. Here's the part nobody wants to hear. Wealth building is largely a function of how willing you are to be bored. The exciting financial life and the wealthy financial life are almost always opposites. The exciting life involves stories you can tell at dinner. The wealthy life involves spreadsheets you don't share with anyone. The exciting life features new apps, new strategies, new thesis. The wealthy life features automatic transfers that have been running for 9 years untouched. The exciting life produces stories. The wealthy life produces options. Ramsey Solutions surveyed over 10,000 millionaires for their national study of millionaires. The findings are uncomfortable for anyone hoping wealth came from something flashy. 79% received zero inheritance. Only 31% averaged $100,000 or more in annual income across their working years. 80% invested in their company 401k plan. 3 out of 4 also invested outside of company plans. Not a single millionaire in the entire study cited single stock picking as a major factor in their wealth building. Not one. The path was always boring. Consistent saving, index investing, low debt, long time frames. The same 5 or 6 habits repeated for 2.5 decades, on average, before crossing the $1 million threshold. The average age at which people in the study reached millionaire status was 49. The average time it took to get there from the start of their working life was 28 years. Slow, boring. Repeatable. Almost everyone watching this video could replicate that exact path with the exact same kinds of assets if they started today. The only thing that would stop them is a continuous distraction by something more exciting. I want to talk about something subtle that nobody warns you about. The boring assets we just walked through don't reward attention. They punish it. The more often you check your S&P 500 index fund, the more emotional you become about its movements. The more emotional you become, the more likely you are to do something stupid. Sell during the next crash, buy aggressively at the top, switch funds because you read an article, move money around because you're bored. Every action you take inside a long-term return, the most successful retail investors, according to multiple studies including a famous internal review at Fidelity, were people who either forgot they had accounts or were dead. Their portfolios outperformed everyone else's because nobody was actively making them worse. This is the deeper truth about boring assets. They reward absence. They reward the willingness to set up a system, walk away, and let it work. The reason most people fail at this is not because they don't know what to do. They know. They've seen the same advice 100 times. They fail because they can't tolerate the boredom. They need a story. They need to feel like they're doing something. The need to do something is what destroys long-term returns more reliably than any market crash. If you want to build wealth quietly, you don't need to outsmart anyone. You need to set up systems that don't require your attention. Then resist the constant urge to mess with them. The asset classes work. The math works. The variable that determines whether you actually capture the math is whether you can leave it alone for 30 years. So where does this leave you? You've now seen the 9 boring asset categories that have built more wealth for ordinary people than every flashy alternative combined. You know the broad strokes of how they work. You know the rough numbers. The remaining question is whether you can build a foundation underneath the assets that lets you actually use them. Because here's what nobody mentions when they talk about index funds and Roth IRAs. None of these assets do anything for you if your financial foundation is unstable. You can't consistently invest $500 a month if you don't know where your money is going. You can't max out your Roth IRA if surprise expenses keep forcing you back to credit cards. You can't take advantage of an employer match if you've never sat down and figured out what your actual take-home is. The boring assets only work for people who have built clarity, stability, and a basic system underneath them. The wealth building stage is the second stage. The reset stage comes first. If you watched this video and felt a knot in your stomach because you know your finances aren't organized enough yet to actually use any of these tools, that's normal, and that's exactly the part most people skip. I built a digital product called the Financial Reset System specifically for that gap. It's a complete workbook that walks you through getting clear on your real numbers, finding where your money is leaking, sequencing your priorities, and building a 30-day plan that creates the foundation everything else gets built on. Every number auto-calculates as you fill it in. The PDF guide walks you through each step. The 30-day plan gives you weekly checkpoints. The link is in the description and in my profile if you want to check it out. The reset comes before the wealth building. Once you've got the foundation, the boring assets do the rest. Here's the closing thought worth carrying with you. Every generation looks back 20 years later and recognizes that the wealthy people in their cohort were the ones who quietly bought the boring stuff and held it. The exciting investments of any era almost never produce the wealthy people. Tulips didn't, Beanie Babies didn't, day trading didn't, most crypto cycles haven't. The next exciting thing won't either. What produces wealth decade after decade after decade is what produced wealth the decade before. Ownership in productive assets, held for enough time that compound returns become the dominant force. The simplicity of that statement is the entire secret. It's also why nobody can sell it back to you in an exciting package in any way. The boring assets are still here. They've been here the whole time. They'll be here 20 years from now, quietly working for the small percentage of people willing to use them as designed. Whether you become one of those people is a decision you make today and then make again tomorrow and then make again every month for the next 30 years. The math doesn't care how you feel about it. It just keeps compounding for the people who keep showing up. Boring builds wealth. Exciting builds stories. The choice has always been which one matters more to you when you're 70.